Health Globe is in the medical travel business. We help individuals get medical care in other parts of the world outside of the U.S. And people from the outside the world actually to come into the U.S. for health care. We also help corporations with something that's called corporate medical travel, and that allows corporations to save significant amounts of money when they leverage corporate medical travel and get procedures done out of the U.S. at a great discount, but still getting great care from world-class doctors. So having set the stage for that, and we'll get back into some of the details and opportunities with corporate medical travel. Keith, why don't we, since the name of your company is Stop Loss Brokerage, why don't we talk about what stop loss means and why it's such a compelling idea as people start to really look at their bottom line?
Certainly, Peter. Stop loss, and I kind of coined the company name about 9 years ago after having worked in the self-funded arena for about the last 28, 29 years. Stop loss is a very integral part of a self-funded platform for a plan sponsor that elects to structure their benefit plan on a self-funded basis. It's simply the contract that limits the plan sponsor's exposure, meaning the amount of claims dollars that they have to fund on an individual basis and also typically on an annual, what's referred to an aggregate basis for the plan year. Mm-hmm. So again, a stop loss amount is very much proportionate to the size of the group. For instance, a 50 life group may have what's referred to as a specific stop loss level of 15 or 20,000. A 2,000 life group may have a stop loss level of 200,000. Right. And that simply refers to the amount of claims that they fund. The group is responsible for each member as they're incurred.
Right. So let's take a step back now. Let's talk about self-funded insurance, because I think we just sort of skipped over that. Self-funded is when a corporation or a school district or a group that has sort of a known entity of individuals they have to cover chooses to self-insure, right?
That's correct.
They go outside. They don't use an insurance company anymore. They put together. They work with someone like you to put together a program.
Well, they don't always have to work with me, but that's what I've been doing for 28, like I said, 29 years. Yes, self-funding has been around a long time. What you find in examining the healthcare program histories throughout the country is that it seems to be a much more popular funding vehicle in certain regions. The East Coast, certainly the Midwest in Ohio. There are a number of very quality third-party administrators in that state. It's essentially one of two ways of funding a health plan. The other being a traditional fully insured plan offered by any one of a number of carriers such as Anthem Blue Cross Blue Shield, WellPoint, Aetna, Cigna, United Healthcare, etc. That involves a fully insured arrangement, typically where the plan sponsor or group pays a set premium based on a single family or which is a two-tier or even a four-tiered rating basis based on their monthly census figures. And they pay this premium into the carrier, and the carrier administers the plan for them and funds claims accordingly. In a self-funded scenario, the plan sponsor has some risk involved in that they agree to fund a good portion of those initial upfront claims. Again, as we were talking earlier, the stop loss portion is typically determined by the size of the group. So, as I mentioned, a 50 life group may have a $20,000 amount that they fund. A 2,000 life group may have a $200,000 specific
And that's
fund.
per person.
That's per member
Uh-huh.
typically. Yes,
And
it's per.
I understand school districts do a lot of self funding. Is that right?
Yeah, and probably they do so simply because of the size. And just briefly touching on that, what you find in the industry is that there are a number of myths really associated with self-funding, and one of those is that a plan sponsor must be at a certain size level for it to make sense. And this has largely, in my opinion, been perpetuated by a number of the so-called proprietary or fully insured carriers who have traditionally set the bar at, say, 150 lives or 200 lives or 300 lives before they would even agree to offer a self-funded contract to one of their plan sponsors. Now, also realize that these same proprietary carriers are marketing a fully insured plan right alongside their self-funded block.
Right.
So
And
the
they make
rationale is that a number of these carriers would prefer to have this block of business, what they consider the small group block, on a fully insured basis.
like
And
they make
it,
more margin.
exactly,
Yeah.
it's a profitability margin.
Right.
It's very profitable business, and typically they do not have to disclose um, underwriting data, loss reports on this segment, so they can maintain their profitability with very little questions
Mm-hmm.
and very little accountability asked.
Right. Interesting. The characteristics we were just talking about that a little bit. The characteristics are not about size, it's not about the population so much as it is about the management style, the management philosophy of the organization. Would you agree with that?
Very much so. There has to be a buy-in from the management side of it. Certainly, in many instances, the broker or the consultant serving the group should have experience with a self-funded plan and be comfortable in explaining it to their plan sponsor.
Mm-hmm.
Um, in some instances, that works very well, and in others, we've run into some communication roadblocks in terms of promoting this platform.
Right. And what they need to be prepared for, in my understanding, is they have to be a little bit sophisticated when it comes to the risk and how you protect against the risk. Right.
Very much
That's
so.
really where it comes in. They buy reinsurance essentially to defray the cost, like you were talking about the stop loss,
Right.
so that assuming you all have young female, maybe mostly teachers in a school district, you might have a certain expectation in terms of their health costs for the year, but then there's outliers. Something bad could happen to someone, and we never want to see that happen. That person might need to get surgery or procedures that would go beyond what you've planned for, and then you have reinsurance involved. Is that right?
Very much so.
Okay.
Yes, and kind of back to the numbers question, just to share an example, the smallest self-funded account that I ever wrote was a small group of urologists, 17 employees, that were based in Florida. And the scenario was that they had been fully insured with Blue Cross Blue Shield of Florida for a number of years. They every year received Beyond Trend, which was probably 20-25% rate increases simply because of the um, type of industry. A healthcare industry is a loaded occupation. So proprietary carriers know that as much as anyone, they certainly know how to extract the most out of a health plan, so to speak.
Right.
So they were simply tired of the game, and they decided to self-fund, which we did, and we wrote a small 10,000 specific reinsurance stop-loss contract on them. Their scenario was that they were paying about 155,000 renewal in fully insured premium dollars, and the year we wrote it, Their reinsurance or stop loss premiums were about 50,000, and their maximum funding level, their maximum aggregate claim level was about 110. So their max case scenario, if you will, was about 160, and again they were paying about, I think, about 150,000 in premium. So they decided to move forward with it. The first year of their plan, after all the dust settled, they had incurred just over $7,000 in claims.